Welcome to Investors Insights, where today's topic is the economic tug of war. First off, we want to hope everybody's having a great Labor Day holiday weekend. But we named the vlog this week Economic Tug of War because there's a couple things going on in the market. One, manufacturing reports last Tuesday showed a lot of growth and a V-shaped recovery occurring. Actually, 4 months of expansion in the manufacturing sector. But then 24 hours later, the jobs report showed a total private payroll was only increased by 428,000. That was well below the expectations of 1.1 million jobs expected. So, look, the reality is we're not close to the pre-COVID employment levels. And so there's a lot of conflicting data that the market is having to contend with right now. And why we think a diversified strategy going into the election is very important. So, again, a tug of war among all the different economic reports coming out. But Adam, talk about seasonality and also the technical levels.
Yeah, Bobby, I appreciate it. And back to your point, last week we alluded to three tactical risks in the markets, and those were seasonality, sentiment, and stretch. And the two we're really focused on right now is seasonality and sentiment. And seasonality, that comes into play. You're talking about the election. So we're in a season of being 2 months out. That's going to be really important to look at from a trend standpoint. Also, with COVID, we're seeing outbreaks again in Europe. Will that continue to be a global pandemic situation? Can that come back to America? Also, from a sentiment standpoint, we talked about the consumer. So personal income rose last month. That's important to look at. Trey kind of alluded to the point, what is this consumer going to do with the money that they are saving? Are they going to put it back into the markets, or are they going to hold on to it? That'll give us a lot of indication moving forward with trends with the consumer. And also, too, we really want to keep an eye on that mark, the 3550 mark of the S&P 500. So, that is our resistance level that we're keeping an eye on. If it's going to continue above that trend, we might see a more bullish market. If we see it fall below that trend, we could see some bears come out. So it's definitely something to keep an eye on.
Trey, give us an update on the dividends. What's going on with dividends right now?
Yeah, definitely. So a positive sign out of the corporate America is that August was the first month since the crisis that no companies announced a dividend suspension. In March, April, and May, during the crisis, 40 companies out of the S&P 500 announced they were suspending their dividends. 19 announced they were going to have to decrease their dividends. There's a lot of investors out there that rely on that income. They use that income to live on, and those that don't use to live on, they reinvest that dividend. So the dividend payments from companies is a sign of corporate confidence, but then it also gives investors confidence when they receive that check in the mail from companies. So it's not a long trend, but it's a good trend to see the first month since March where no companies suspended their dividends. So hopefully that'll extend into September, and we'll start to see companies maybe start to increase their dividends, which we really haven't seen at all. And so it's not an overly positive sign, but we're looking for just kind of some green shoots to begin to turn the market to maybe some sustainability on the positive nature.
Yeah, and then Ashley, a big reason why we're seeing a lot of momentum in the market from March is because of the action that the Fed took. The Fed was very proactive in what they did. Talk about that. Give us an update on what the Fed is doing.
Well, they've done that, Bobby. And then about a week and a half ago, they quietly had one of their most prolific policy changes in a 73-year period going back to 1947. A little history on that. As we've said on the vlog many times, our Federal Reserve is unusual in that it has what's called a dual mandate. We try to control employment or unemployment, however you want to phrase that, and we try to control inflation. That dual mandate in the United States goes all the way back to 1947 when President Truman with the Fed put that in place. So we've really had that dual mandate all this time. And around inflation, that's the one that's sort of breaking down a little bit in terms of the way that the Fed handles it. It is a major policy shift. What do we mean by that? If you go back to the early 2000s, the Fed has had an unofficial, if you will, inflation target that they look at in controlling the economy about 2%. They made that an official target in 2012. What happened Thursday was a week ago is that now they're looking at it totally differently. They're building it around that 2% rate, but it's more of an average across 4 or 5 years. So, for example, if you have a couple of recessionary years, they don't mind letting inflation run above that target a little bit now, as long as the average is good. And the reason that is important, we get a lot of questions from viewers, why don't we seem to have much inflation in the system anymore for the Fed to control? There are 3 major reasons for it. One is technology. Second is the proliferation of global supply chains. And 3, since we're on Labor Day, and that was really originally a union holiday, the third is that you have much less union influence in the United States. Back in the 70s and 80s, a lot more union influence could raise prices sort of in bunches nationally. So those 3 dynamics are a major reason that we had about a 10-year expansion, Bobby, with no inflation in it. So the Federal Reserve is having to adjust in the way that they're looking at it. It'll be very interesting for markets going forward.
Yeah, the market initially reacted very positive to that meeting, because what it meant was lower rates for longer.
Yes.
It's been the story the past few months. And again, while the market has some momentum here because the Fed was proactive in their actions. So, again,
if you're a borrower, you're in great shape.
Absolutely. Yeah. And so we hope everybody's having a phenomenal Labor Day weekend, and hope everybody has a great week. We'll continue to keep you informed. But in the meantime, if you have questions, please email us, call us. We love to hear from you. Have a great week. Thanks.